What is up, everyone? Welcome back to the trading world. Guys, I know I did not go live this morning. As well, I have been falling behind on the market recaps and short form videos. But guys, one step at a time, every single day, I'm going to get better at doing these things for you and making these videos day after day. So if you guys like this type of content, definitely consider subscribing, leaving a like, following me on X. I'm going to start saying that now because it's called X. Why would I not call it that? And then, what's the other thing? Oh, joining my completely free Discord. The link to that is in my bio. So, we're going to be covering price action for the past 2 days because, as you guys probably realized, I missed the last market recap. So, let's jump right into it. So, as you can see from on the higher time frame, right, from before, we talked about how we had these super nice low resistance lows, how there'd be a lot of stop losses beneath them, and we ended up sweeping out all of those lows, getting an aggressive reaction off of them, and at which point light bulb goes off in your head that this is likely to be manipulation. And this signature where we get aggressive displacement on the higher time frame, do you see how these candles, they mean business? We're aggressively displacing. That's the light bulb that needs to go off in your mind to say, oh wow, yeah, the fair value gaps within each of these displacement legs are likely to hold. And where are they likely to hold? Equilibrium, right? So guys, this is the signature you're going to see over and over again in the market on all time frames, right? We're going to sweep liquidity, we're going to start displacing, and I know technically you're supposed to have a break of structure, but the key is displacement, right? This is displacement. The fair value gap has displacement, so this fair value gap is likely to hold, this 4-hour fair value gap. So you can see this 4-hour fair value gap, I'm going to even consider a 2022 fair value gap, right, is likely to hold, and it does. And where does it hold? Right at equilibrium. Then we have another one, right? We get aggressive displacement. We have another fair value gap. Where does this one hold? Right at equilibrium. So you can see how when you're in a trending environment, we're going to come back to these fair value gaps at equilibrium and then continue to expand. So that's the higher time frame for you. Let's jump down to the lower time frame. So we had price action yesterday and today. Yes, let's start with yesterday. Yesterday was kind of tricky because if you traded at all in the afternoon or in the late morning, you can see here we had very, very tough conditions. These are called high resistant liquidity conditions. And why is it called that? Let's pull up an image. We gotta go to Thursday here. We had high resistant liquidity conditions. And guys, this is something you're gonna need to train your eye to. So what is high resistant liquidity? What even is that? So, you know, when we're having you guys probably know what low resistance liquidity is. It's when we're actually ready to go run old highs or old lows. So it'd be on the opposite side of the curve, we'd be drilling through them. But when the market fails to run through them, it's not low resistant, it's high resistant. So every single time that we try and go run liquidity, it's a failure. It's a failure swing. It's a failure to do so. These conditions are really hard to trade unless you're like a really good trader, because you have to understand that like every single time it looks like we're going to go run liquidity, like inverse value gap, oh, we got to go. It's not going to go. And you guys just have to be able to identify these conditions. Like right as soon as you realize that these are high resistant conditions, either step away from the charts or just try to understand that it's high resistant conditions and use that to your advantage. But guys, be super careful in these conditions. You're going to want to wait for something obvious before the market's ready to go run this liquidity. You can see every single time we try and go run it, it's not ready to, and that's because we're on the wrong side of the curve. The market's not ready. The market hasn't completed the model yet, right? That's something to be very careful about. Anyway, right in the morning, right, this was on Thursday, we had a giant accumulation range, and let's see, yeah, you can see we just range all morning. So I actually did trade this day, I got on the charts at 8:30. There was a trade that Dodgy liked. It was this 2-minute inversion. I noticed it, right? We swept out all these lows of this accumulation, and we end up getting this inversion. Personally, I know that, Dodgy likes his trades and all that, but personally, it was not worth it for me to take. Why? Because, once again, I like those trades with those low resistant liquidity runs, right? I'm not a huge fan of these ones, but, if this one was light bulb enough to you, and you thought we were going to break this external gap, once again, this is an external gap. So sometimes these can be hard to break, but it kind of depends on the context. In this context, it was likely to break because we had a giant range and then we popped off that low, right? So external gaps, typically you don't want to trade into them, but sometimes you can if you go in with the mindset of, oh, I'm just going to go break even when we hit that gap. And you can see that actually ended up working out. So, and as well, some people took this inversion to the downside that happened here. Once again, though, there's nothing wrong with this. I'm just looking for something incredibly high probability since I am trading all my accounts now. I want something undeniable, but this was decent, right? We inverse this down. It's on 2-minute as well. Once again, another AMD type of setup, right, where we just sweep out the highs and then we inverse the downside. Anyway, at this point, right, we're essentially just waiting to see, okay, which way is the market going to manipulate before expanding the opposite direction? This is the key, right? We're anticipating accumulation and then manipulation and then distribution, because once we figure out, okay, with a high probability the market's done manipulating, we can get onside with distribution. So let's see if I have any images of this. Alright, this image is okay. It's a little excessive, but right, we accumulate, we sweep liquidity. I'm just gonna draw it out actually because I think that's a little overcomplicated. We sweep liquidity, and at this point, this is a very obvious liquidity sweep, right? This is literally, when you look at the 2022 model, this is literally episode 3. This is exactly what you see, if you guys remember that, where you just chop sideways, you sweep the high. I think we had S&T here. Let me check real quick, because it's important whether or not we had S&T, but I believe we did. Yeah, we actually had 2 SMTs. So that's what made this so super nice, is we have SMT with both of these highs. So you can see there's an SMT, and then we have another SMT, and we were also within a key level. It was like a 15-minute order block. I can pull that up real quick. You can see this up close candle before this violent move down. That's an order block. So drag that over, and you can see that we fill this perfectly. And then, yeah, you see how the market filled that perfectly, right? And then we get a sweep of liquidity, so accumulation. And once again, there was SMT with this high too, so stacked SMTs. What's stacked SMT? It's when there's a lower time frame SMT and a higher time frame SMT that are both acting on price in the same direction. So there was a lower time one here. I'm not going to mark it out, but just know that there was a lower time frame one. And if you guys don't know what SMT is when you have a breaking correlation between highs where one asset makes a higher high and another asset makes a lower high. So for instance, if I switch my screen, whoops, you can see that S&P made a lower high here and NASDAQ made a higher high. See that? Higher high, lower high. That's a cracking correlation. That's S&P. Okay, back to what we're talking about. So anyway, we sweep that high. So that's, at this point, light bulbs going off in your brain, right? This is a liquidity sweep, and we break this low. And we also kind of somewhat break this low, but this one's not that obvious. This one is where it's obvious to me, right? So we break this low, So this is like essentially our 2022 model, and yes, I would consider this a fair value gap, even though it's not legitimately a fair value gap. Combine these two candles into one, and all of a sudden, yeah, this is obviously a fair value gap, right? So fair value gap, and a lot of people took a trade essentially like this. A lot of different ways to take the same idea, but at its core, when you simplify it down the most, it is essentially just a 2022 fair value gap and a liquidity sweep break of structure. So this is the same model TGR trades, right? This is a 2022 model. So anyway, liquidity sweep, break of structure, fair value gap. From here to here, it's in premium. From here to here, we go up to equilibrium. And once again, I like this displacement leg because this is the most obvious one, right? This one's not nearly as obvious. This one's the most obvious. And you can see we hit equilibrium of that. So anyway, we break structure right there. Break of structure. And also, guys, what is this? So this was a 15-minute order block. 15-minute order block, bearish order block. And then a 1-minute change state delivery. So see how this overlaps with our flow state entry? Pretty cool, huh? Right? We have both of our models overlap with each other, and that's what's typically going to happen. Oh, another really cool thing about this is, look at our time levels, right? Your optimal entry, so much of the time, is going to be above our key times. So our key times, you guys want to write this down. Our key times are midnight, 8:30, and 9:30. If you're going to enter short, you want to enter short above those times. If you're going to enter long, you want to enter long below those times, and that's going to be an additional confluence. And you can see how often your optimal entry point is going to be just barely above those time levels. It's like perfect like that. It's crazy, but that's just how it works, right? The market remembers these times, and smart money enters as a confluence. If we're above these times, they're going to use it as an additional confluence to enter their trade. So anyway, that was pretty cool, right? 9:30, 8:30. So there's 9:30, and then here is 8:30, and then we just expand lower from there, right? You can enter at that 2022 gap, and let's measure out standard deviations, right? So from the high to the change state delivery, whoops. Once again, sure, you could use that one, but it's just not obvious enough for me. I wanted to wait for this. Nope, look at that. We backtest the kill shot entry, the Jake trades it original, right? Where you measure out the change state delivery to the high. A lot of the time, we'll backtest OTE before we get our change state delivery. So check that out, right? OTE backtested. You could use that as an additional confluence. And if you don't know what OTE is the 0.62 retracement, 0.71, and 0.79, I think. And in that area, that's going to be sniper entry, right? So from that OTE, I mean, it'd be a crazy risk reward trade. But once again, I'm not taking those until I get a little better, or I want to practice on a personal account, or just on a demo account or something. But as of right now, right, you can just take it like this. Since you're taking it as a 2022 model, I think it'd be fair to put stop loss above this because, this is the most obvious swing high. And then, measure out standard deviations. We hit 1, 2, 3, and then 4. And see how perfectly we hit that fourth standard deviation? See how perfectly the market runs on these models, guys? Pay attention, because this is going to happen over and over and over again in the market. And once you see it, you cannot unsee it. And obviously, you're going to be scaling out all through here. Like, this is never all or nothing. Scale and trail, right? Scale and trail. Take some off at 1, take some off at 1.5, take some off at 2. As well, let's say you entered at the OTE because you were a degen. You see, that'd be 15-1. So, pretty cool. Oh, another thing I wanted to say about Thursday is I found it very, very cool that we actually had, let's see, where was it? This rejection block. I thought we had SMT with this. Oh, we have SMT. Okay, yeah, so dropping down to lower time frame, we have this SMT, right? This lower time frame SMT, and this is really cool, right? So this is a very low time frame Phoenix model. We have, and once again, guys, my video on the Phoenix model is wrong. All you need for Phoenix model is a rejection block and an SMT, and you just enter at the rejection block. And ideally, you want the rejection block to sweep some kind of liquidity. So the video I made on the Phoenix model is what's it called? It's like a flow state adaptation of the Phoenix model, but the regular Phoenix model is just, you know, SMT with a rejection block, and that's all you really need for the actual Phoenix model. And it's going to be really, really high RR. But yeah, a lot of times it's going to be very, very high RR. But I need to make a video updating that because, you know, I want to correct that. That the video I made was like a flow state version of the Phoenix model. But anyway, 1 minute rejection block with stacked SMTs. And check that out, right? We react perfectly off that rejection block. And if your stop was up above the rejection block, you can see this is a very, very high RR trade. And these are the kinds of trades Powell Trades takes. And Powell Trades, guys, go look at his videos on his YouTube channel. Powell Trades is doing, let's just say, very well for himself, right? Man, could you imagine that? So I just want to shout that out, that was a little Phoenix model at the top there. So that's how you could top tick that, 14-1. Anyway, all through here, high resistant conditions, every single move higher ends up failing. And then, yeah, we come all the way down. And so let's talk about Friday. So now we're getting into Friday. Sure, there might have been some tricks in there, but once again, that was high resistant conditions, so it was going to be hard to find anything super good. So Friday was super cool because one thing I learned on stream from Hyper, thank you Hyper by the way, is you can actually use first presented fair value gaps for a long time. Actually, like, I don't even know, they really just kind of stay working and they just slowly decay over time. Like, same with new day opening gaps, new week opening gaps, right? They stay working even into, you know, later in the week, and then sometimes even the next week and even further. So draw these out, right? Because you'll be surprised how long the market will remember them. And check this out. Drawing this out all the way. Oh, this was just for reference. This was the first presented for value gap from Tuesday. So here's market open at 9:30, 9:31, 9:32, 9:33, 9:34, 9:35, 9:36, 9:37, 9:38. There we go. That's the first presented one. Why is this one not the first presented? Because the sequence of 3 candles, this includes the 9:29 candle, meaning it was not after market open. So drawing this out all the way, let's drag it. See there, the market barely taps it, rejects it, and then continues through it. Look at that. Look at how perfectly the market remembers that fair value gap. And also, guys, not just is this a first presented fair value gap from Tuesday, but it's also a Reaper fair value gap, right? Why? Because, well, this is a really obvious breaker. Why is this such a good breaker? Because it is the last up close candle before this very violent move down. That obviously takes stop losses. Obviously, people are getting stopped out here. So this 1 hour breaker is going to be very, very strong. And guess what else, guys? You're never going to believe it. But if you guys remember what the Reaper fair value gap is, it is when you have a fair value gap in discount of a breaker on the lower time frame. So here's this 1 hour breaker. So 1 hour breaker. And then going over, let's drop down against the lower time frame. So 1 hour breaker, what fair value gap is in discount of this breaker on the lower time frame? You'll never guess. It's the same fair value gap. So the Reaper fair value gap was also the first presented fair value gap. And this is the first time I've ever seen this. But guys, this is so powerful. And honestly, I mean, this, like, it works so well. Like, I'm honestly going to give it its own name. And so I called it this, right? I call it the Superstar gap because, I mean, genuinely, look at how well that held. When it was both a Reaper fair value gap and a first presented fair value gap. And, I mean, yeah, it's like literally you're on Superstar mode if you're in Super Mario. Like, you feel like this is going to be like an unstoppable gap. Especially with all these these are going to turn low resistant highs. You can see that ends up happening here, right? These all end up turning low resistant. So, yeah, this is like a crazy barrier in the market. Like, good luck breaking through this. And then you can see there's that signature in price that we always talk about where the market starts expanding aggressively, breaks old highs, and then we retrace back to a fair value gap around equilibrium. We aggressively break old highs, we retrace back to a fair value gap around equilibrium. So this displacement and the retracement into fair value gap signature when you're driving up towards old low resistance highs, it's going to be very strong. And you can see that's exactly what happens all through here. I found it to be very cool. Then, yeah, that was kind of like PM sessions. That was later on the day, but you can see eventually these high resistant highs become low resistant. It just takes something like this, like Superstar gap, to actually change that. Then over here, so this was Friday, we had a really nice London reversal, New York continuation day. Very textbook daily profile. And if I pull up Discord, I can show you this, right? London reversal, you guys probably know what this is, but London reversal, New York continuation is when London hits a key level and then reverses, and then New York continues in the same direction. So here you can see this daily profile. Here it is, where London hits a key level and then New York continues. See that? London hits key level, New York continues. This is going to be probably the most common daily profile. So once again, a daily profile, if you don't know what a daily profile is, it's just a more common type of day than like a random day. It's going to be more likely than, you know, just random price action. These statistically happen in the market over and over again. And this one specifically, when Asia will move sideways, London will manipulate, and New York will continue. So anyway, here you can see that is the case here, right? We had Asia accumulate, and anytime you see Asia make a really obvious accumulation range, you should definitely try this. Measure out either the candle bodies or just the range itself. In this case today was really good measuring out the 1 hour bodies. So the 20 o'clock candle, the 21 candle, the 22 candle, and the 23 candle, right? Because those are the candles that are making up Asia. So, well, I can't get it to show up right now because it's too high of time frame, but these four candles together are Asia, 20, 21, 22, 23. So check that out. Check this out, right? Drawing this out from body to body, and then turning this to standard deviations, and then dropping back down to lower time frame. This is the power of range projections, where, and I need to move this out a little bit, where, what do you see? What do you see? You see this was Asia, this was the accumulation range. Smart money measures out these time-based accumulation ranges, and actually just accumulation ranges in general, and uses the standard deviations of them to get their orders filled. So here you can see one standard deviation below Asia measured from candle bodies is the exact low. You see that? And then if you go up 4 standard deviations from Asia measured from candle bodies, you can see that's that high. Pretty crazy, right? So if you were anticipating this daily profile, since the higher time frame was bullish, if you were anticipating this to be a London reversal, New York continuation day, well then you could bottom tick this thing at the -1, because you're basically saying today should be a London reversal, New York continuation day. So I'm going to just use the -1 as an entry for the entire day. And you can see that's exactly what happens. So here you can see, I gotta pull up Friday now, it's a different folder. Here you can see the more full version of this, right? We measure out Asia from candle bodies. London manipulates, and then New York continues. And actually, this was a 1 hour BPR. I'm not going to pull it up. It's going to take too long. This was a 1 hour BPR. And then on the higher time frame, so this was a 1 hour, 5-minute flow state model where London manipulates, 5-minute change state delivery. Orders get filled at the change state delivery this entire time, and then we expand to the upside, drilling through Asia's highs. And if you wanted to, once again, you could have turtle souped these lows below the change state delivery. Remember that video I made on turtle soup, how the best turtle soups will be below the change state delivery? Well, you can see that this, so once again, inducement, turtle soup, they're the same thing, but I call this inducement, where you buy beneath an old low, which is in line with this higher time frame model with this 1 hour gap, and it makes sense because of liquidity, because you have this giant range. So you soup that low, and once again, you could even look for a lower time frame entry off of this with just using this model as bias, and then we expand to the upside. And you know what else is cool about this is we have, this is a new day opening gap. The very bottom of this, we tap that new day opening gap 1, 2, and on the third time, I haven't made a short form video on this yet, but this is called the precision swing point. The third time we tap it, we get a precision swing point, which is when one asset forms a red candle, and that one correlated asset forms a red candle, and another correlated asset forms a green candle. And on the retest of this precision swing point off of a new day opening gap, typically you're going to want to see S&Ts as well. And there was one here, and I don't know if there was another one, but there was at least one. And on the retest of this precision swing point, either on the wick or the body, it's going to be very, very explosive. So bang, bang. You see, and you're going to want to have waited a little bit, right? You're going to want to see the market just consolidate around here for a little bit. And then once we hit that third time with the precision swing point, that's going to be very sensitive, and then we expand aggressively off of this. This is quarterly theory stuff, right? This is stuff that Trader Day talks about a lot. And there was S&T with this low, but found that to be very cool. And then lastly, talk about one other trade before the market opened. Once again, accumulation, manipulation. And here's just a simple 5-minute change state delivery. There's a 1 hour BPR as well, but you honestly didn't even need to know that. You could have just probably entered on the change state delivery and been fine because of liquidity, right? You know, with this SMT and this 5-minute change state delivery close, that we're probably going to at least go to these lows, which means it'll probably be break even, and then we should continue lower to this new day opening gap. And then bang, perfectly hit. So yeah, that was a lot, guys. That was a lot, but I think this was a pretty cool episode. Pretty helpful, hopefully. And obviously, there's way more trades you can take. I feel like these videos could be like 4 hours long, but I'm not going to make it 4 hours long. I'm just going to end it here. And yeah, hopefully this was helpful. Hopefully you enjoyed, and hopefully you maybe learned something. And I'll see you guys in the next one. Peace out.